Section 24, mortgage interest relief cap. We all know the theory, but how do you show this on your tax return? Well, that's a great question, and it is something that Louise will share with you in this video. So yes, good evening. How do you deal with interest paid on property with 3 shops at the bottom and 3 flats at the top? So we're talking about a mixed use property, aren't we? So again,
lovely question.
Just out of interest, where is when we just hold that paper up, yeah, hold that for me, because we need to reference this. We need to get into good habits here. We need it on the back chart somewhere. They can't see it though.
No, I know. I'm just trying to work out where my finger's going to go for it. Okay.
Right. So where would property income come from? Commercial or residential? Does it go on the same page?
So typically, whether it be rental of residential units or rental of office units or rental of garages, doesn't really matter. It will all still go in the rental box, which I think is the one I'm pointing to. So box 20 up here, rental income. Okay. Hopefully you can see that. So that's all going to go in there.
Because the big question that comes out of this, and anyone listening in understanding Section 24, means that you cannot offset residential mortgage interest against your tax return. In fact, there's a couple of boxes here. Is it shown in this one to say allowed and disallowed?
Not really, no. So this tax year, 2021, which is what this tax return is the first year in which no residential finance costs are allowed. So what you have instead, I don't know if you can see where my little finger is here. So box 26 is your non-residential finance costs. So if you were, for example, renting out exclusively properties, or rather buildings that were non-residential, offices, warehousing, garages, then you would capture any finance costs associated with running them here. That's where you capture that, because that is still a tax-deductible expense for your business, which is a real kicker in the teeth, but it is just the way it is. If, however, you only rent out residential property and you have mortgages and therefore pay mortgage interest, I'm afraid you are relegated, for want of a better phrase, to load in your finance costs down here at box 44, this one second from the bottom on the right hand side. And there is, in my brain, quite psychologically, a good reason it's down at the bottom, because it's considered at the bottom of the pile for saving your tax. Because now it is not treated in the same way in terms of assessing what your profit is, which is then what is assessed for tax calculation purposes. If you have, like DA test, KA I think it was, a situation where you have a single building and some of it is residential and some of it is non-residential, then you have the opportunity to capture some of your mortgage interest, assuming you have it mortgage interest, DAK test, here for the non-residential portion, and here for the residential portion. So you're in a place where you can arguably assign some of your finance costs to a tax deductible line, which most people cannot. How do you decide how much to load? If it's in a single building and you've got a single mortgage on it, then you could look at apportioning some of those expenses across both the residential and non-residential parts. So there's 2 ways that I would typically look at this for a client. The first way is I'd look at the floor apportionment. So I'd look at how much of the floor area is non-residential compared to residential, and I would use that to inform me how to split across those 2 finance cost boxes. The second methodology is to look at how much rent those 2 different types of units give me, and then use that as the method to apportion how much I load in the expense. And quite frankly, I would use the apportionment version that allows me to load more of my expense in this lovely top box up here, where I can use the finance cost to minimize my profit, and as little as humanly possible down here. I would, of course, use the apportionment method very carefully and rigorously, so that if HMRC did inquire, I have good logical data to explain how I'd come to the conclusion, as opposed to, well, finger in the air, I thought it was about 25%. That would be my...
Today, start saving tax tomorrow.